let's talk about a fundamental truth of finance. Markets almost never move in a straight line, right? They twist, they turn, they soar, and then they dive. Today, we're digging into the why behind all that drama. We're talking about market cycles.
I mean, if you've ever watched your portfolio for more than 5 minutes, you know this feeling. It's that absolute thrill when things are shooting up, and then that pit in your stomach when it all starts to fall. It can feel like a totally random, unpredictable ride.
You look at these two extremes. You've got the powerful bull on one side and the punishing bear on the other, and it just looks like pure chaos. But what if I told you there's a hidden rhythm to all these dramatic swings? A pattern that actually repeats itself over and over and over again.
Okay, so here's our map for today. First, we're going to uncover the market's hidden rhythm. Then, we'll break down the whole cycle, the climb and the fall. After that, we'll look at what's really driving these waves. And finally, how you can actually use this map to invest with the cycle, not against it.
All right, let's dive right in. At the very heart of all that market noise, all the headlines, all the panic, there's a surprisingly consistent pattern that just keeps repeating.
So, what is a market cycle, really? Well, put simply, it's just the natural rise and fall of prices over time. But the key thing is, this isn't random. It's a process, and it's driven by some really big things like the state of the economy, what central banks are doing with interest rates, and maybe most importantly, our collective human emotions.
And lucky for us, we've got a guide. This is a classic model known as the Wyckoff market cycle. For our purposes, just think of it as our map for the whole journey. It shows us the 4 key territories that pretty much every market travels through.
And what are those 4 phases? Well, they are accumulation, then expansion, then distribution, and finally, contraction. So let's break this whole journey down, starting from the very, very bottom.
All right, we're going to focus on the first half of the cycle now. This is the big ascent, that long, and let's be honest, pretty emotional journey from the absolute market floor all the way up to the peak.
You know, every new cycle starts quietly, almost secretly, in the ashes of the last one. This is phase 1, accumulation. It happens after a massive decline when most people have just given up. But this is when the smart money, the big institutions, start quietly buying things up while they're cheap.
The signs here are really subtle. Prices finally stop plunging and just kind of drift sideways. The news headlines are still terrible, and most everyday investors are completely scared off. But behind the curtain, the big funds are building their positions. Volatility just dries up. This is the foundation being laid for the next huge move up.
And then, eventually, the market starts to wake up. Prices finally break out of that sideways rut and begin a real, sustained climb. This is phase 2, expansion. This is the bull market that everybody knows and loves, where public confidence finally starts to creep back in.
And oh my gosh, this chart just captures the emotional roller coaster perfectly. It all starts with disbelief, right? Anyone who just lost a ton of money is thinking, no way, this rally is fake. But as prices keep climbing, that disbelief turns into hope, then optimism. Pretty soon we're at thrill, and then right at the very peak, euphoria. This is that dangerous moment of maximum financial risk where everyone feels like an investing genius.
But of course, euphoria is one of the most dangerous emotions in the market. So now, we pivot to the second half of our journey, the inevitable fall from that dizzying peak all the way back down to the bottom.
So while the general public is jumping in, totally caught up in all the excitement, that smart money that bought way back in the accumulation phase, they start to sell. This is phase 3, distribution. They're literally distributing their shares to all the enthusiastic latecomers, quietly cashing out their profits.
And here's the crazy paradox. Just as optimism is hitting an all-time high, the market's foundation is secretly cracking. You start to see volatility tick up. That powerful upward momentum, it starts to slow down. And you'll notice that everybody, your barber, your cousin, is talking about their hot stock tips. The party is always loudest right before the music stops. And then the music stops. All that buying pressure is gone, and the market finally tips over. This is phase 4, contraction. The dreaded bear market begins, and it's defined by some pretty significant and sustained price declines.
And trust me, the ride down is just as emotional as the ride up. It kicks off with complacency. Investors think, oh, this is just a healthy dip, a buying opportunity. But that quickly turns to anxiety, then denial, and then panic, when people are selling everything just to make the pain stop. It all bottoms out with anger and depression, where people feel foolish and swear off investing forever. And ironically, that's the exact moment the cycle is quietly getting ready to start all over again.
Okay, so we've mapped out the what, the 4 phases. But the big question is, why does this happen? Let's take a look at the powerful forces that are actually driving these massive waves.
It really boils down to 4 main things. First, you've got monetary policy. Think of a central bank lowering interest rates. That's like pouring gasoline on a bull market. Raising them does the exact opposite. Then there's liquidity, which is just a fancy way of saying how much cash is floating around looking for a place to go. Third is economic growth. Obviously, when companies are making more money and the economy is humming, markets tend to do well. And finally, the big one, the engine behind it all, investor sentiment. That collective swing between fear and greed that we just walked through.
So, why is learning all of this so important? Well, because once you have this map, it gives you a real, practical way to make smarter decisions and actually navigate the market's constant ups and downs.
Honestly, understanding this is a total game changer. It helps you zoom out from all the day-to-day noise and see the bigger picture. It lets you spot those amazing long-term buying opportunities when everyone else is terrified. It helps you manage your risk when everyone else is euphoric. And maybe most importantly, it gives you the discipline to not make emotional mistakes. And hey, this pattern isn't just for the old-school stock market. Take a look at newer asset classes, like crypto. The cycles of boom and bust there are, well, even more wild and dramatic, but that underlying pattern of quiet accumulation, euphoric growth, and painful crash, it's exactly the same. Because at the end of the day, all this journey really reminds us is that markets are driven by us, by people. The entire cycle is just a giant reflection of our collective psychology, swinging like a pendulum from absolute fear to absolute greed and right back again. Knowing where you are on that emotional map is probably the most powerful tool you can have as an investor.
So, I'll leave you with one final question. Now that you have the map, you understand the 4 phases, you know the economic drivers, and you've seen the emotional journey. Take a look around at the world today and just ask yourself, where in the cycle do you think we are right now?